All right, guys. Well, I had this video before on my channel, but I felt like I was like missing some stuff, so missing a lot of things here. So I thought I could do it again. Do it again for the sake of good information to be provided to you. And don't forget to subscribe and give me a like or something, and share this video with a. Hi guys, welcome. I'm gonna be doing this valuation, this discounted cash flow and EV evaluation, economic value added valuation, using this spreadsheet that we used before in the last video, in which we were finding out the three dynamic this three financial dynamic financial statements for a certain project, that under some initial assumptions, and providing some values that were normally distributed with a mean and a standard deviation in the beginning. Of course, the outcome of that was an income statement, a balance sheet, and statement of cash flow, and we know that we did it correctly, because the difference between if you take the assets and subtract the liabilities and equity, you get zero. That's the difference, and this is how we know that the calculation was correct. And this is kind of like going to present this to your boss or to your bank or whatever, if you're seeking for some some cash or solution to finance your project. Okay, so that's basically the thing. But from here, we need to evaluate this alternative. I mean, what are we gonna do here? We're gonna be valuing from the point of view of the company, because we're discounting at WACC. Of course, if this project is valuable to us, it provides value, and what is it worth? So if you remember well, you just go ahead and go back to your books or whatever, or do your notes, and you see that when you were evaluating something, you were doing a cash flow analysis with a negative value in the beginning, and then mostly positive values. And then if the net present value was above zero, then this project was suitable for you or for the company, given a discount rate. Yeah, well, this is basically what we're gonna be doing here, but we're gonna be using the discounted cash flow valuation of this project. And let me say that again: valuation, discounted cash flow valuation of the project, not of the company, the project at this point, right? And that's gonna have to match with the economic value added to this company, since those two valuation techniques should provide the same value, the same number. Okay, so that's for something. Okay, so this one, the discounted cash flow, takes into account that you're investing something and you're progressively increasing your investment, right? And subtracting the cost of that, subtracting the the money that you receive from the investment that you made, right? This one, on the other hand, it's telling you, look at the formula here. You get a net operating profit after taxes, and then you subtract that from your weighted average cost of capital times the capital invested on the operation, the past, the last, the former operation invested capital. Okay, the past of the last year invested capital. So that means that the money that you're receiving today, as opposed of what you could get from that money if you invested somewhere else, then you bring all that to present value, and you add this initial investment, and there you go, you have it. But the thing is, the things that are getting different here, when the thing that turns these two valuations to be equals is the growth rate. But I'm not going to be so picky with this. I mean, I'm not gonna take any longer with this, and I'm just gonna show you what I mean by this. Let's just go ahead and start. Don't forget that I'm gonna leave this sheet on my coffee site, which you can acquire, or you can get by $5, but as always, you can get it paying whatever you want, whatever you think you can help me out with. I mean, you're like supporting the channel and supporting my work here. Or if you want to invite me a coffee, well, that's well received, and I thank you very much for that. You can do that on my coffee too. And well, let's start. Okay, so we have this earnings before interest and taxes that I pulled off from the income statement that I'm gonna be finding the taxes, which is the tax rate. I think over here, yep, times the value here. All right, I'm gonna drag it to the right here. So we finally found the net operating profit after taxes. The difference between this and the net income, that's going to be because we didn't take into account the interest expenses, which work like a shield, like a tax shield. We were just talking about the operation here. Okay, so we add the depreciation expense back, which we're going to be pulling off from the income statement too. And here we start off with the dance. Okay, so with the initial cash, that's gonna be from the statement of cash flow, this number over here, which we had wait, hold on, here we pulled from the money that you borrowed from the bank and the money that was provided by the shareholders, and then you subtract that and buy the capex, and then you have this additional money that you have over here, and you have to take into account. Okay, so now the variation of the accounts receivables, and it says that we should be starting off with a minus. So minus accounts receivable final minus the initial, and the same goes for the variation of the inventory. We start off with a negative value, open parentheses, and then future minus last, or final minus initial. Now for the variation of the accounts payable, that's a plus, and then we go for final minus initial, right? Okay, and I think we should be like dragging this to the very end. This is not gonna take long. And then the capex, well, that's minus my blue cell, that it's already over here. You know how fond I am of painting the cells, and I'm gonna be adding this negative value to future investments. So for that, here it is. Okay, so we add this up from the net operating profit after taxes to the very end. And here we have the free cash flow for the relevant period. Now we're gonna get the terminal value, and that's only using the last cash flow times 1 plus G, which is gonna be here, that one, divided by the WACC, or the weighted average cost of capital, minus the G. I'm gonna get a big error because I didn't put the what am I here? Okay, 17. Yes, great. Okay, and I'm gonna get a big error here because I don't have a walk. So let's just go ahead and put it from the previous calculations over here, and let's say that we have like, I don't know, whatever, 5% maybe growth rate. That's a crazy number, so it doesn't matter. Okay, no, for the moment this doesn't matter. That's the thing that's gonna be getting those numbers to be positive or be equals. I mean both valuations. Okay, all right, I didn't erase this, so I was checking it out. Okay, so the enterprise value or the project value, better, that's a wrong name, but with this one, it's more appropriate. I mean, the project value, that's gonna be your initial investment plus the NPV. We're gonna be using the WACC. The rest of the values over here on the last row. Here we have it. Okay. Now we start off the economic value added with the same figure, so no need for us to be calculating that back in. And then the capex, which is gonna be, and this time it's gonna be a positive value from here, 2022, and then we're gonna be adding progressively in time what we have. Just in case you didn't understand that, well, let's just go ahead and pretend that we bought something like 1500 or something, so it's gonna be adding this up here and it's gonna be subtracting over here, as you can see. Well, that's previously formulated in the other sheet that I left on copy too, and I'm gonna leave this too. Okay, so the accumulated depreciation expense, well, that's gonna be my negative value, and I'm gonna go like here. This is 0 because this is 2022, so this is 0 for year 2022, and 2023 all the way to 2027 go on. Okay, now for the initial cash, of course, you know, that was the positive value over here. Yeah, and then your accounts receivable, I'm just gonna link that with positive number over here from my balance sheet. Accounts receivable. Now your inventories, same goes for the inventories, and minus your accounts payable. You know, can you see what the difference are from here, right? So I'm gonna select this, only this 3, and I'm gonna take them back, because if I take this one, it goes crazy. This is not correct. Okay, now the invested capital, let's just add this up, right? Yeah, from the capex down, and then we're gonna be following this equation over here to get the economic value added, and that is your net operating profit after taxes minus your WACC F4 times the past capital invested on the operation. And you drag it to the right, and we do it all over again because it does have terminal value too. Just yeah, in terms of the growth rate too, divided by, and then open this up, WACC minus G. I hope it does work, because I think I'm missing some parentheses over here, but I think it's gonna work. Let's hope it does. Now let's just go ahead and add this. Okay, we got that. So that's exactly the same as we did before. Now we have to include here. Okay, let me just erase this format that I did. I didn't do it on purpose, but yeah, I mean, I have this tendency to put some colors and stuff so I can do this, so I can just be precise, don't miss anything. So I have the capital invested in year 0, so the enterprise value or the project value right here, it's gonna be your year 1, year 0 investment, and the net present value of the economic value added. Yeah, that to the very end. Here you go. Now we have a difference between the cash flow and the and the economic value added, which is $2,000. All right, and that solves zoom in a little bit. So we get to get this number correctly, we're gonna be using a different value here, and that's gonna be in charge of Excel. So you go to data, what if analysis, go seek, set cell with the value of 0 by changing the cell to growth rate. Okay, so 2.29, that's our growth rate, and that's basically what the use of doing this operation is. I mean, you can tell, you know, this is what math is telling you, what's gonna be the growth rate equivalent, you know, the equivalent growth rate, the most likely growth rate from year 2007 on for this accurate valuation. So this is a pretty straightforward and very solid number that you can say that this is going to be the present value of the number that you're doing here above your value. I mean, if you got a 0, this was just providing exactly what you're asking from your money, and this is providing a lot more than what you're asking from your money. That's basically what the net present value terminology will lead you to. But there are some subtle difference here, because as you can see in the discounted cash flow, you use a difference. You know, this is how the variation works. But this in the economic value added, you put the whole thing. I mean, you're using the whole value. I mean, you know, for the accounts receivable, inventories, and account payables, and that's gonna be multiplied by the WACC. So that, in other words, just to remind you, this is what you have to leave in the company, and the extra money that you have to leave there in order to be able to generate this free cash flow. Okay, and this one is what the company is providing, as opposed to what you could get somewhere else by investing a certain amount of money given a discount rate. And that reconciles, that turns out to be equals if you have a proper growth rate for both of them, you know, for the terminal value, because as you can see, those numbers will never match in, you know, the ones, you know, the free cash flows and the economic value added, they're not gonna match in because one takes into account something different than the other one. That's you know, by definition and by math, they're never gonna be matching up. The thing that makes them match is the terminal value for both of them, right? So that's basically it, and this is it. Well, thank you very much for watching. Don't forget to drop a like and share this video. Please go ahead and check my coffee site, and if you can, you invite me a coffee or download this sheet. I'll be much appreciated. I'll really appreciate this, my effort and my work, and I'll thank you very much for that. I'm gonna leave it. I think it's gonna be for $5, but you can pay whatever you want. Of course, if I load something in a site like that, well, it's gonna ask you for something in return, right? So they have to profit from something. So otherwise, I'll do it for free. And the other ways that I've tried to share this, they didn't work, and you know, it'll be nice to see if you guys could support this channel, you know, making some money in the middle, you know. Well, okay guys, so thank you very much for watching. I'll see you. Bye bye.
I just want the paper, the visa, the visa. I'm out the